On his return from the G20 summit in Brisbane, David Cameron warned of a second global economic disaster. What follows is a World to Win's overview of the global capitalist crisis. In Part 2 we'll introduce our proposals for making the transition beyond capital. As 2015 began to unfold, a deflationary crisis was gripping the world. Despite 6 years of pumping credit into the system and increasingly severe austerity, governments and central banks had failed to bring about a recovery from the crash of 2008. But what they had done was to provoke millions onto the streets, creating opportunities for revolutionary change. In the UK, real incomes had been driven down by as much as 15%. It was worse in Ireland and Spain, and far worse in Greece. Many, not least in Wall Street, could see the unfolding disaster of the deflationary spiral, but those supposedly in control were helpless to do anything about it. Debt rose faster between 2007 and 2014 than in the 7 years preceding the crash. Measures including quantitative easing added 57 trillion, more than 1/3 to the global total. Soaring debt outpaced growth measured by GDP, rising to 286% by the middle of 2014. In February, global consultancy McKinsey showed the contradictory nature of debt, essential for the global economy, but liable to place a drag on growth when high and to spark financial crises and deep economic recessions. Neil Woodford, now a global investment manager who had received a CBE in 2013 for his services to the economy, echoed Thomas Piketty, explaining how pumping credit into the financial system makes the rich even richer, driving inequality to the extreme. In the period since the crash, the share of wealth owned by the richest 1% rose from 44 to 48%, whilst the share owned by the 99% declined from 56 to 52%. If these numbers don't impress you, here's another way of looking at it. If this carries on, the 1% and the 99% will each have 50% by next year. Maybe that's what they mean by equality. And here we can see that the wealth of the top 80 richest people last year grew to surpass that of the bottom 50% of the world's population. Meanwhile, the world's financial markets have erupted in chaos once again, and you can be sure there's much worse to come. 1 year ago, Fortune magazine's list of the top 500 global corporations was headed by these 12. As you can see, 5 of the top 6 and 8 of the top 12 were oil companies. But since June, oil prices fell by more than 50% as slowing global demand met rising production. This precipitous slide triggered a competitive crisis amongst the producing companies and undermined the viability of countries dependent on revenues from oil exports. Here are just a few of the recent headlines. Into February, US inventory, that's oil in storage, reached record highs, and traders invoked a strategy known as contango, which means hiring and filling up immense floating tankers called very large crude carriers. They were gambling that the cost of on- and offshore storage would be less than the hoped-for gains to be made by waiting for a return to higher prices. The expectation of continuing overproduction led to more announcements of reduced investment. Note that the reasoning, preserving cash to maintain dividends, shows the determining logic of capitalist production, which is the competition to attract and retain shareholders. But from the rose-tinted glasses of Apple's perspective, you might question whether there really is a crisis. In January, they announced the biggest ever corporate quarterly profits, bringing their cash reserves to a record. Most of this came from the sale of nearly 75 million iPhones in the quarter, on each of which they made an astonishing 40% profit. And in a revealing example of global corporations more powerful than any government, they borrowed $6.5 billion, raising the cash they needed to return capital, paying dividends to their US-based shareholders. Why? Because most of their profits are made abroad, and to minimize the tax they pay, they stash the cash in banks outside the US. So this kind of competitive pressure from globalization on nation states that's driven corporate tax rates downward since the war. So let's focus in on corporate profits in relation to GDP. This is the whole period since the Second World War, and you can see how the post-war decline was reversed by the advent of Thatcher-Reagan neoliberalism, sending profits soaring in the mid-1980s. So how do they do it? If we look at labour productivity and real wages since 1999, we can see that productivity has risen faster than wages, and it's this gap that is the source of additional surplus value from which profit is derived. Here we can see the declining share of GDP that goes to labour in developed rich countries since 1991. And here's the same chart for the countries most affected by the crisis and austerity. That's Ireland, Greece, Spain and Portugal. In China, despite increasing real wages, the share that goes to labour has also been driven sharply down. So you can see where Apple's super profits come from. This chart shows that confidence in the economy in the US turned positive in 2015 for the first time since the crash. But it looks as though that confidence is about to be smashed once again. Clearly rattled on his way back from the G20 in November, David Cameron issued a loud warning. It's time, he said, to expect a second global economic disaster. He spoke about international instability, uncertainty, and the slowing of growth in emerging markets. And then, in January, the spectre of deflation appeared in Europe for the first time since the crash. A series of headlines tracked the slowdown in China. After rising to 12% in 2010, funded by a massive state injection of credit after the crash, GDP slowed to 7% in 2015 and continues to slow. This slowing growth is reflected in the world oil price, which has declined slowly since 2010 until the sudden collapse last year. But it's not just oil. Copper follows the same path, responding to an unrelenting global slowdown that began in 2012, following the trend set in 2010. And this is Bloomberg's composite index of commodities, reaching the lowest level since 2002. So let's take a closer look at the deflationary spiral. Falling prices lead to debt defaults, bankruptcies, layoffs and wage reductions, falling demand, and then another turn of the screw. In January at the World Economic Forum, Anthony Scaramucci explained it like this for the average citizen. It's the Darth Vader Death Star outside of the atmosphere of the Earth, shooting a laser to blow up the world, he said. And then highly successful hedge fund manager and UKIP funder Crispin Odey sent out a bombshell letter to his clients. The global economy faces a downturn that will be remembered in 100 years. Equity markets will get devastated. Volatility is rising, he said. But this time around, the problem is that politics will start to rear its head. We are left to deal with politicians who are increasingly critical of the capitalist system's ability to allocate capital. And he wasn't just talking about Syriza. He continued, "We used all our monetary firepower to avoid the first downturn in 2007, so we are really at a dangerous point. If economic activity far from picks up but falters, then there will be a painful round of debt default. We are in the first stage of this downturn. It is too early to see what will happen. A change of this magnitude means the darkness and mist is very great." The story from China has them all spooked, as it highlights the crisis of excess productive capacity and its consequences. Okay, so there is a crisis. But why? And what opportunities does it present? If we look not at profits, which as we saw have increased as a proportion of GDP, but profitability, or the rate of profit, we get a different backstory. In the US, we see a general post-war decline interrupted for just 15 years by the neoliberal boom, and then a return to decline ever since. The trend is the same at the world level, and I've drawn in the growth path that was needed to offset the decline. By January the 15th, in advance of the announcement that the European Central Bank would begin its QE program in March, the strains in Europe and the global economy forced the Swiss bank to stop protecting the franc against the crisis of the euro. The effect was to further deepen the crisis. Scrapping the cap meant hitting exports, throwing more people out of work, and maybe tipping the country's economy into recession. The competitive currency war began to spread to Denmark, then to China, and on into Sweden. At the end of February, the fall in the price of oil hit the shale-based recovery, sending the US itself into deflation. Then a chink of reality appeared in the fantasy world of debt, when the Croatian government set out on the road of debt cancellation, at least for the poorest. So to recap, the world is in the grip of a deflationary crisis, markets are in chaos, and all those supposedly in control are helpless. But revolutionary opportunities beckon. In Part 2, we'll look at the potential for resolving the crisis by making the transition beyond capital.